Hey guys, Rafi here from the Endgame Investor, and it seems that the Fed doesn't know what it's doing because it's asking Wall Street and other economists whether a meltdown like what happened in the UK at the end of September could happen in the US Treasury market. And the answer they got back after their canvassing of random people was, yep, it could. Well, now what? So, just to make sure we all understand this correctly, the Federal Reserve is going around asking Wall Street bankers if the Treasury market could collapse. In other words, the people whose entire careers and livelihoods rely on the Fed printing more money are being asked if the Fed should buy more treasuries or if the Treasury market could collapse if they don't. I wonder what they're going to say. Are they going to say, oh, no, it's fine. You don't have to print any more money. We'll be fine. Nothing will collapse. Just don't worry about it. Just chill. We'll take care of this. Or are they going to say,
where's the money, Lebowski? You want that money, Lebowski? Where's the money, Lebowski? Where's the money, Lebowski?
It's down there somewhere. Let me take another look.
look, Fed, it's very simple. You don't have to go off on an investigation or looking for any promising leads.
You got any promising leads or
Leads? Leads.
When you interfere in a market to the tune of many trillions of dollars, I think it's like $8 or $9 trillion now, it's going to get messed up. This is what happens when you mark interest rates at zero for 10 years.
This is what happens. You see what happens, Larry? You see what happens, Larry? Do you see what happens, Larry, when you fucking zero?
Things get messed up. And once the treasury markets start to break down, the Fed's going to go right back in and market zero again. And that will be the end of the dollar system. This isn't rocket science. It's more like junkie science. Junkie bonds. Yeah, I like that. Doesn't just make you feel all warm and gooey inside. The people in charge of the monetary system are asking Wall Street whether a breakdown in treasuries can happen.
Don't that just warm the cockles of your heart aging sights? Warms the shit out of my cockles. My cockles are burning.
Here's the article. After UK market blowout, American officials ask, could it happen here? Federal Reserve and White House officials spent last week quizzing investors and economists about the risks of a British-style meltdown at home. And quizzing isn't like giving them a test like, could this happen? A, yes, B, no, C, all the above. They don't know. They're asking. They don't know if this is going to happen, which, they're the ones who buy treasuries, so they kind of should know, but I guess they don't. And it's by three people, Smilek, Tankersley, and Renison. That sounds like a nice trio. Maybe they're a throuple. Washington, Federal Reserve researchers and officials quizzed experts from Wall Street and around the world last week about a pressing problem. Question, could a market meltdown like the one that happened in Britain late last month occur here? And the answer they got back, according to four people at separate institutions who were in such conversations who spoke on the condition of anonymity to describe private meetings, was that it probably could, though a crash does not appear to be imminent. Well, that's convenient. It's not imminent. Well, what are they supposed to say? Yeah, it's imminent, so everybody sell now.
Everybody panic! Oh my God!
Okay. Here's a good quote from Roberto Perli, some guy at Piper Sandler, which is probably a very important place. In the market, there is a lot of worry, and everyone is saying it feels like something is about to break, said Roberto Perli, an economist at Piper Sandler who used to work at the Fed and who was not part of the conversations last week. He added that it made sense that officials were checking up on the situation. Well, it makes sense that they're checking up on the situation. You should just feel calm because the people, they're in charge and they're checking up on the situation. But it gets more explicit than that. From Mark Cabana of Bank of America, who's actually a pretty good analyst from what I've seen for a Keynesian. Let's go into what he says, and he gets into way more detail. I'm not sure if this is a joke or what, but it says here in the Financial Times, B of A, treasuries could also get buried like gilts. UST breakdown is a growing risk. Have a great weekend. Thank you, FT. I will. And this is by a guy named Ashworth. He's worth all the ash in the world. An old axiom goes, each day on Twitter. That's an old axiom. Who wrote that? Aesop? Ashworth quotes Mark Cabana. And this is the biggest quote of Mark Cabana I could find. And here he says, in the bold, clients have asked if the Fed could follow suit, meaning follow the UK market breakdown. We think yes, in extreme stress. The Fed wants to blindly pursue its quest to get inflation down, but deteriorating market functioning or frozen credit could push them to intervene. We have long argued that QT would stop under one of three conditions, meaning the final pivot, meaning the oncoming end game, which is going to happen once the Fed turns around one last time, in my thesis at least. 3, market functioning breakdown. And here in the bold it says, policymakers assume the UST market will always be liquid. It won't. Liquidity is a privilege, not a right. I learned at the DMV that it's the same with driving. I think it might come from Japan, the final thermal viscosity breakdown in the US Treasury market. And why this happens is pretty simple. When you have a central bank that can print monetary units coming in and buying trillions of dollars of a certain thing, then that market gets kind of sleepy, like it's on fentanyl or heroin or opium or whatever it is that, clogs up your system, makes you constipated and happy at the same time. That's exactly what the bond markets are. And I'll show you exactly how this is true in Japan, which is the most fentanylized bond market in the world, to the point where trading on some days is literally zero. Here's from Bloomberg. Trading drought worsens in Japan's broken bond market. This is from October 11th, by Chikako Mogi. I love these guys. In a fresh sign of Japan's dysfunctional bond market, the 10-year benchmark failed to trade for a third consecutive session on Tuesday, the longest such streak since 1999. The Bank of Japan's overwhelming presence in the JGB, Japanese government bond market, where it's the biggest buyer under its curve control policy, has exacerbated liquidity issues and led to a deterioration in market functioning. And so, literally, on some days, Japanese government bonds do not trade at all because nobody wants them, because the rate is so manipulated that it is very risky to hold, because there could be a waterfall decline any second that the BOJ, the Bank of Japan, decides to step away and let interest rates rise. Because if they are literally the only buyer, then they can't let it rise slowly. Who are they going to sell it to? Who's going to buy it at a rate that's slightly above the 25 basis points where they pinned it at? So if they step off the gas even a tiny bit, rates could jump like, 100 basis points in a second, because there's no buyers on the other side. And in the meantime, the Japanese yen is collapsing because they refuse to raise rates as the US is raising rates. And so the dollar-yen differential in interest rates is getting wider and wider, which means the yen is falling off of a cliff. And so at some point soon, the Japanese bank is going to be forced between allowing its currency to die and raising interest rates like, say, 75 to 100 basis points in a second. And in the meantime, who is the biggest foreign treasury owner in the world? That would be Japan, not China, Japan. It's left over from the old alliance post World War II. When somebody bombs you with nuclear weapons twice, you kind of buy their debt for many, many decades because you're their bitch. And so here is the yen. The higher this is, the weaker it is against the dollar. We are now at 150 yen per dollar, and this is higher than the 1998 Asian financial crisis, when the Bank of Japan last intervened in the yen market. How are they intervening in the yen market? They're selling the dollars they have stored at the Fed's reverse repo facility, and they have something like 120 billion in there. And then after that, they're going to have to start selling their treasury hoard. And when they start selling their treasury hoard, that is when the treasury market could end up seizing up, like the UK gilt market, forcing the Fed to go in hard and creating a major U-turn in the metals and a major tanking in the dollar. And if the public catches on to it and sees that the Fed is printing with inflation rates, with consumer prices still rising at 8 to 10% a year, then they're going to dump the dollar in the street. And the Fed can control banks, but it cannot control the public. And Daniel Oliver of Myrmikan adds that one trigger could be when Japan decides that it must start selling some US treasuries in order to support the yen. Other countries with big holdings might front run so they don't lose their holdings and try to get out in front of them. And then you have a whole tsunami of sales from foreign central banks selling all of their bonds at the same time. And what does that do to the US Treasury market? It causes forced selling and then a cascade, and the Fed's going to have to, do what it does, print money. We're not that far away now. Once it does, there will be no going back because everyone is going to sell their treasuries to the Fed altogether, and they're going to shoot the moon. And we see that the Bank of Japan is already making moves in the yen market by selling its dollars. Look at this. If we look at a 1-month chart, we see here that the yen reached, well, it looks like 151.5 per dollar, and then suddenly it was a smack down, which means up to about 146.5, and now the market's fighting back and weakening the yen again. There were 2 interventions here, it looks like. There was one on October 21st, and then another one on October 24th. They've done it twice. They're selling dollars, and if they run out of dollars, they're going to start selling treasuries. So if you want to know when the treasury market could seize up, I don't know this for sure, but the yen is a very good indicator, it seems, that if the yen goes out of control, weaker and weaker and weaker, then the Japanese are going to start selling treasuries, and that's going to start a cascading waterfall. And everyone's going to be surprised about it and say no one could have predicted it. And that's how it's going to be. Except those that own gold and silver and real money will be okay in terms of their purchasing power. But those who own bonds, whether in their retirement accounts, 401ks, 302Cs, ROFBs, I don't know what anything is, but it's all going to die. This is Rafi with the Endgame Investor, coming at you at this week's... No, I'm not doing the silver report. This is Rafi with the Endgame Investor. If you enjoyed this video, then subscribe to a 2-week free trial of the Endgame Investor, or become my patron on Patreon, where I give actually more than once a week now. It's more like twice a week. I'm finding some interesting stuff, some biblical commentary on economics and finance and government. And I'll see you guys in the next few days. But I won't see you guys on Saturday. Why not?
I'm Shomer Shabbos. Saturday, Donnie, is Shabbos, the Jewish day of rest. That means I don't work.
Shomer Shabbos!